Welcome, everybody, to our Let's Make a Deal panel. It is my pleasure to introduce to you the moderator for our panel, Jonathan Pierce. JP is an executive vice president at Ivanhoe Cambridge. He's in charge of their leasing and development on a global basis. With $70 billion of assets under management and 1,200 properties or so, he is a very busy man. I've had the pleasure of working with JP over the last several years, and I can tell you he's a great deal maker. So with that said, JP.
Great. Well, we'll do our best not to disappoint. Thank you very much indeed, Peter. So I'm actually going to let our panel introduce themselves, because rather than me prattling on about them, I think they can probably tell you who they are and what they do best themselves. So please, Scott.
Thanks, JP. I'm Scott Goodman. I am a principal of Farpoint Development, offices here in Chicago and also Asheville, North Carolina. We are developers of commercial, industrial, multifamily, and data centers.
Well, I'd first like to thank DLA Piper for inviting me here, but
wait a minute.
I have one
and
quick-
thank you, DLA Piper,
Yeah,
for
yeah,
inviting
yeah.
me here today.
Second.
Okay, please
I'm
go ahead.
I'm that guy. I'm
Go
that
ahead.
guy.
Right.
Carrie?
Yeah, and we're friendly equity too. But suggestion box next time, please never have me follow General Mattis and General Kim, because like that was incredible, and that's a much more important conversation. But I'm glad we're having this one. So I'm Joe Gorin. I'm at Barings. We're relatively new in the world. We were formed in 2016. I run our U.S. acquisitions and portfolio management. We have $50 billion of assets under management in real estate. My business is about $12 billion of equity. We do core plus, value add, and open-ended and closed-end funds, and then we have about a $35 billion book of debt, and we span from US, Europe, and we're growing in Asia.
My name is Doug Lyons. It is great to be here in person. I'm the managing principal with Pearlmark here in Chicago. We're a real estate private equity firm. Got offices in New York, Denver. We just opened an office in Nashville. We've been active dating back to 1996 when a small group of us came out of Sam Zell's group to start the predecessor firm in middle market value add equity. Really started out focusing on office and industrial, but mainly we've been active in multifamily and growth Sunbelt markets. We also started in 2001 the credit side of our business, and we've been very active providing mezzanine debt capital to sponsors and developers, and that's a very active business for us today. Personally, I'd just like to say that I'm incredibly passionate about the sport of soccer, and I am going to try and make it to Qatar. It'll be my 9th World Cup in a row.
Wow.
Excellent. I'm Tal Perry. I work for Union Investment. We're Germany's largest open-ended fund with 60 billion AUM in real estate. In the US, we have roughly 6.5 billion, and we're mostly a core fund investing in all 4 major food groups.
Great. So I've got a few questions. I'm going to direct maybe some of them to specific people, and then I've got a sort of a number of them that are sort of more jump ball in nature. So whoever has something interesting to say or amusing to say, please share it. So I think first topic I'd like to touch on, because it's so topical, is interest rates. So obviously, Fed Chairman Powell about 10 days ago moved the rate up by 50 bips. And that's I guess within a couple of months of him saying he was probably only going to do 25 bips. So that plus obviously the QE contraction that's going to be happening simultaneously doesn't exactly sort of lend itself to sort of think about a soft landing. So based on the sort of the Fed policies and sort of where you see things going, and the fact that there seems to be some sentiment growing that maybe the U.S. might be heading towards some sort of stronger recession, late 22, early 23. What are your thoughts, and how's that impacting your thinking about buying and selling real estate? So maybe first I'll send it to Mr. Tal.
Thanks so much. Well, first we have to acknowledge that the Fed has a difficult job, right? We have inflation that is going through the roof, and even though they're increasing the interest rates, they know that a lot of it is not going to be solved by just interest rate increases with all the supply chain issues and some of those more sticky inflationary topics. But the increase in interest rates is here, and the repricing has started already, retrading in some deals, smaller pool of buyers in bidding processes, even though a lot of brokers are going to tell you, no, it's not yet in our market. Our market is so strong, we don't see repricing yet. But if you're close enough, or if you're involved in any of those processes, you will see that. So we have to deal with this, and repricing is real and it's important. And so on the sales side, it leads to a lot of people thinking, let me sell something very fast, right, before this repricing happens, and squeeze in as much as I can and get old cap rates. It almost seems, because especially if you go through like a broadly marketed process, that it may be too late to do that before you get at least a part of that repricing. That's why we see a lot of off-market approaches or more targeted, smaller groups, 4 or 5 people being called, and to test the market. So on the sales side, everybody, including us as a big fund, are evaluating what could be an interesting deal to dispose of at the right pricing. But it's definitely not easy, because the buyers also see all the stuff that we will talk about throughout the panel. On the buy side, you need to be very disciplined. You need to be patient, because the repricing happens, and you need to be courageous. Why courageous? Because nobody wants to be the guy that pays a cap rate that's old, and then after a week or 2 or 3, it looks like it was a really expensive deal. And so that's kind of, but it leaves room for whoever is courageous enough to believe in that specific asset, in a specific asset class, and take advantage of that dislocation.
So Tal, congratulations. You've covered all the panel material with one answer. I was going to ask.
I don't think I've ever been called courageous.
So Doug, anything you'd like to add on that topic?
Yeah, no, I think it's a real challenge. I mean, the cost of debt capital, clearly has gapped out, and it's a combination of the underlying index, either fixed rate or floating on its way up further. So the cost of debt capital has increased probably at least 150 to 200 basis points, and you mark that against trades that are still being talked about at 4 caps or lower, and you're talking about negative leverage, you're talking about diminishing cash yields. Where do you mark on an exit cap rate basis? How do you peg that? It's not easy. And then the transactions today, especially if you're dealing with floating rate debt and there's a requirement for an interest rate cap or hedging, those have exploded. And that's basically blowing up a number of transactions today.
If I could just add,
Please.
on the heels of that, and the exit cap question is a huge one, because we don't know where the starting point is. We all look at the fundamentals and say 10 basis points, 5 basis points per year, so we get over 5 or 10 years another 100 basis points, but I don't know where that starting point is now.
Yeah.
And that's a problem. And then you say, well, it's a discount to replacement cost, but I don't know what replacement cost is. So I think it's a real.
Well, that's going up.
Well, yeah, great. So that justifies paying more, right? Yeah, but I'll tell you that, and I'm going to be the no bullshit guy here. And we all will. I've got 2 deals under contract right now, and the last thing I want to do is price adjust a seller, because our reputation precedes us. However, we're going back for big price adjustments on both deals, because they were awarded within the past 30 days, and the debt pricing is different, and every seller right now has to be ready for repricing, and I hate to get it when I'm a seller, but I don't think any deal that's been awarded over the past 30 or 60 days is going to close as expected.
So you both used the phrase repricing. We're definitely going to touch on that later.
Not
Scott?
retrade.
Yeah.
All right,
Repricing.
retrade, reprice. Okay, fair enough. But something, right? So Scott, anything you'd like to add?
Yeah, well, it's always location, we know, but it's really basis, right? And that's what we all worried about as we're buying our properties, and it's where we really make our money, and it's really all dependent on the cost of money, right? We're all just kind of renting money for a while, and with interest rates moving now, it actually changes the entire equation for us. So it's a fascinating time. There's a ton of liquidity still in the market. Rates are moving. Real estate's always a pretty good place to have money during inflationary times. Honestly, I think there's these uncertain times create a lot of opportunity, which we kind of thrive on.
Yeah, it's not bad for everyone, is it?
Right.
So maybe just switching gears. I mean, just talking a little bit about geopolitical. I mean, Ukraine obviously was very topical both last night and on some of the sessions this morning. So obviously with the ongoing conflict and obviously the broadening humanitarian crisis, any of you sort of seeing how, maybe you're looking at sort of changing your investment policies for, your capital allocations globally? Are you sort of starting to think about maybe investment red zones and sort of things like that? I mean, maybe I'll start with Joe. And
Well, we have a European business that's also growing into Asia. talking to our European colleagues, I think that Europe's probably in recession right now. I think that the risk that they go into a deep recession is probably greater than the U.S. right now. Especially if gas gets shut off through the winter in Europe and they're a net importer of resources, that's going to really weigh heavy on them. So we're starting to see the signs of recapital allocation more into the U.S. It's not a wave coming in, but there's one investor in particular who is looking at one of our funds, and they're right now changing their allocation and shifting a little bit more into the U.S. So, we're concerned about it in Europe. However, fundamentally, there's a need for great product in Europe across office and residential. There's a lot of those similar tailwinds. So I think we're a little bit more nervous actually about core investing in Europe. But if we can see our way out 3-4 years from now where we see a little bit more stability coming into the world, taking a value add approach within Europe, not necessarily a core because we don't know where that pricing is and where that near-term demand is, that's a shift. But in general, offshore capital typically invests more as a secular trends. You have to see a paradigm shift for those guys to reallocate. So that's not going to happen that quickly. But if we look 6 months, 12 months out from now, when the Ukraine war is protracted, then I think there's going to be some real allocations.
So I know Scott and Doug are mostly focused domestically, so maybe I'll just ask Tal. I mean, Union, obviously, you're a global capital allocator. I mean, what are you seeing? What's Union thinking?
Okay, well, first of all, working for a company that's based in Germany, within Europe, Germany is our biggest portfolio, and we have obviously a big European presence. But Germany in itself is going to be very much impacted by the Ukrainian war, not only because of the gas and energy dependency from Russia, but also because proximity. There's just one country between Ukraine and Germany, that's Poland. And so we got already in Germany 700,000 refugees. I just came there from there. We had an offsite after 3 years after pandemic and some other things. We had our investment management offsite. And over there, you walk into refugees on the street in the hotels. It's a different feeling. And a lot of the supply for food and other items, even construction material, is coming from that region. And so they're much more impacted. The cloud feels much darker than it is here. I can tell you in relative comparison, we were looking at a Miami multifamily development just at the beginning of the year, right? Everything looked great. The war didn't start yet. Interest rates were still at a good place. The bars were full, and even into the Ukrainian crisis, if you go to Miami and you go into some bars, they're full. The world is great. And there's sun, there are no taxes, and everybody wants to move there, right? So, so it's a different perception, and I think in that sense, Joe is right that there is kind of a rethinking that the US is going to be more stable, it's geographically further away, so I think there's a strong argument for continued growth. And if we look back at the last 2 years in general, GDP growth in net terms, right, was much better in the US than in Europe or in any country. We had the lowest decrease of GDP and the highest rebound. So there is a reason I always say to my European colleague that are wondering, well, should we invest more or not in the US, which we will. There's a reason why we have interest rate increases here, because the economy is actually booming, right? And so even though we're constantly fearful of the interest rate increases, we have to not forget that means we have a pretty strong basis. We're just trying to correct it to a more healthy level and solve the issues that come with inflation, right?
But my son is going to be a freshman in Miami in the fall, so I will tell him that the bars are hopping.
They are.
Yeah, I mean, look, last night, there was quite a lot of discussion about, energy security, areas of sort of, more stability on the geopolitical side, and also food security, which I thought was interesting too. And I think as we all sort of look around the world about, areas that we may invest in or choose to lighten up or choose to sort of tank up on, I mean, I think those kind of themes are going to be on everybody's mind. So maybe why don't we sort of shift a little bit sort of into inflation? I mean, obviously when this inflation reared its head, it was initially described as some as transitionary, which I think was, a little optimistic, and now it's obviously feeling very embedded. So, I mean, I guess I'll ask Doug first. I mean, do you see a period of sort of sustained inflation? How do you see that impacting commercial real estate, obviously beyond the inevitable interest rate hikes?
Yeah, I mean, we talked about interest rate and the impact there. Some sustained inflation actually in some ways is good for commercial real estate to the extent that you can mark your rents and stay sort of consistently in line there. You know, for us, that's been in multifamily, and we've been seeing really nice, sustained, consistent rental rate hikes in our portfolio. You know, over time, you worry a little bit about affordability, you know, where you go in terms of which product you're talking about. And if we do end up in recession and you're in higher price point categories and jobs are lost, where does that leave you? Where does the inflation bring you to rental levels on the more affordable product? So you need to sort of keep a mind towards those issues. And I know we're going to talk about it, and Scott will be talking about it probably in greater detail, but inflation also is very real in cost of construction right now, new supply. And I think as an industry, we've been pretty disciplined. I think about past cycles and how relative to, you know, existing supply, the amount of construction coming online was substantial. You know, today, you know, I think there are pockets of oversupply, but if you look generally across the sector, it's been, for the most part, in check. And one of the reasons why you're seeing the rental rate increases, to the extent that these cost increases continue the way they have been, you're going to see a real pullback in new construction and new supply. And I know we'll get into more detail. So I think about that. But the other thing that I do think about with inflation, and I worry about this with, you know, some of the analysts who are running the numbers, and they're taking the CoStar or the axiometric growth rates like this, and then you look at what they're assuming for expense growth, and it's much lower. So that's a pitfall that you need to be concerned about, is inflation. Obviously, you got taxes, you've got insurance, but even just operating costs, you need to make sure that you're marking those appropriately as well.
So Doug gave us the perfect segue about construction cost inflation. I mean, obviously you're active on the dev, redev side. I mean, how are you managing construction cost inflation? How are you sort of, you know, recalibrating your underwriting assumptions on the cost side? I mean, we're seeing certain projects in certain markets that are seeing like 10 and 15% cost inflation in less than 12 months. I mean, that becomes harder to underwrite, and I think the exuberance that's been in the market over the last couple of years, I mean, there's been a lot of groups that have been burned on the cost side, but they've been skated on side with the rental growth. So if the rental growth starts to, you know, fall back a little bit, how do you manage on the cost side?
Groupon. You get all your materials with Groupon. So it's a problem, obviously. You know, it's when we look at these inflationary pressures and they're real. You know, we've had a lot of things get accelerated by the pandemic, right? Things that were probably trends that were coming. The pandemic really kind of pushed them forward. The supply chain issues, you know, that was, you know, it's an amazing thing how volatile and how fragile our supply chain was. We didn't realize that it was in such, you know, it's the you know, the just-in-time kind of production. You know, it was totally disrupted. So that's the question is, will that solve itself as the pandemic starts to, you know, the effects of that, you know, when the cargo ships start getting, you know, a little more unloaded more quickly, and will prices come down that way? Obviously, prices come down a lot more slowly than they go up. Right. So we don't expect that trend to be turning around anytime very quickly. You know, things, you know, there's so many global factors, you know, things like the you know, the social impact of Black Lives Matter and social impact and just, you know, wages and all those things that were interest rates. You know, in my opinion, interest rates were artificially low for a very long time. They had to move. Mm-hmm. So we were kind of expecting this kind of action for a while, and we, fortunately, we are in pre-development on most of what we're doing right now, so we're able to adjust what we're doing based on current costing. But this is, you know, historically, interest rates are not very high. You know, this is still pretty good. Sure. You know, they've just been so low for a while. Construction costs, you know, we're finding that a lot of our contractors aren't as busy as they were, you know, 4 years ago. So pricing is not, yes, it's up, mostly based on materials. We think they're going to remain high, but not at this level. So we think they could come down in a couple years.
Yeah, we're actually seeing a willingness now on the part of GCs to hold prices, whereas, you know, even 90 days ago, you know, it was like sign tomorrow or, I can't guarantee the price.
Right.
We're giving you a 2-week hold. So, I mean, I agree with what you're saying.
Although if I
you-
may
you
add
look-
on, sorry, please.
Joe, then Tal.
I mean, we've looked at some studies. If you look at lumber, copper, steel piping, structural steel, the range of increases over the past 12 months has been anywhere between 35 and 57%. And the list goes on. I just haven't memorized them all. So for us, it's having a major impact on how we think about the future. And we are continuously seeing increases even today, and we're doing a lot of development. So we're making sure that we've got really tight GMP contracts. We're trying to put as much cost overrun protection on our development partners as we possibly can, and making sure that their balance sheets can handle it, and making sure our lenders are going to accept that. So we're being really careful right now, but we're still willing to develop because that's where you're going to get the highest rents.
Sure.
You've heard every panel talk about how important dynamic modern real estate is. You'll get the rents for it, but you better know what it's going to cost. The other part of the equation is the tenant input costs. I mean, when you look at tenant improvements, what your basis is going to be, we're negotiating deals in our office buildings, and all of a sudden the tenants are coming back and saying, you're $125 a foot, okay, in TIs, that'll get me there. I need to put, I thought, another $150 a foot in. I got to put $300 a foot in, so I need you to reduce my rent by X. So this is having a trickle effect that's really important to pay attention to.
Yeah, I couldn't agree with you more. Tal, you wanted to add something?
Yeah, Scott, I mean, going back to the argument that Scott just made in terms of that interest rates historically are still not that high. And that's very true, and I hear that argument a lot. But the problem is that it doesn't help now to look back and say, what was the interest rate 5, 7, 10 years ago? Because pricing that just happened 6 months ago, if you paid a 3 cap on a multifamily deal and you got financing at a 2.5, that looked pretty good on a net return when you get all those rental rates. And so the speed, and we all expected that interest rates to rise. I don't think it was a surprise, but the speed of it and the amount of it is just astonishing. And it paused because we're talking about repricing, but if these additional steps that the Fed has announced that they will come, if they actually do come, you're going to have a continuous repricing. Once you reprice the last 75 bips, you're going to have another 50 bips, and then you have another 50. So the big fear is really, what are you talking about, 150 bips in like a year? That's really, really hard to digest when you are at that low cap rates that were all based on that very, very low interest rates that we all got used to. And we all, including every broker in the industry, was saying, well, that's never going to change. And every time the Fed or anybody tried, right, or even the announcement was making the stock market nervous. And now it still makes the stock market nervous, but the Fed has no choice than to continue. So it's a pretty meaningful situation, and the comparison to the past is not always helping in the current environment, even if it's true.
So I mean, let's take that thinking and sort of talk about values for a minute. I mean, we're sort of seeing a tempering of broker BOVs, in their opinions. And even in spite of that, I mean, I think there's been some processes that are sort of falling short of the mark, even the sort of amended BOV expectations. So you layer on top of that, many of us, certainly the institutional investors in this room, are sort of judged on a mark-to-market basis. And obviously there's increasing concerns that the appraisal community, I was having this discussion with someone last night, is sort of lagging real asset values. So in the plenary session this morning, there was obviously a lot of talk about repricing. So now we're going to talk about that. So what are you seeing? And okay, Doug, you got your hand up. You go first.
Yeah, I'm just following on Joe's earlier comment. But real time, just in the last week, one transaction on the buy side, another transaction on the sell side. Unusual for us, office, that's in our DNA, but most of what we've been investing in and most of our existing book is multifamily. But for the right office situation, we'll still act. On the sell side, it's really a recapitalization of an existing asset we own with new development, alongside that project, and bringing in a new capital partner, and that, and then on the buy side, high quality office in a Sun Belt market, well leased, but with some rollover exposure. Both of those are getting repriced at about 10%, and it's a challenge for us on the sell side. Do we accept it or not? Because we're under no pressure to sell. We can hold and wait for construction costs to come down, And so that's very real in terms of decision-making in our firm right now. But on the buy side, it's very clear, and it looks like we might have a transaction at the 10% mark. That's on gross asset value, so just think about what that means for equity values on a mark-to-market, taking into account leverage.
It's sobering. So,
I think you
Scott.
really need to think about which asset class you're talking
Yeah.
about too, right? So the office market right now, not that interesting unless it's more specialized like life sciences or something like that. Things, they talked about earlier that you can do, pretty instant, repricing like self-storage and apartments and those type of things, seem like little better ideas. And then, we like specialty classes like data centers and that type of thing where the interest rates really aren't as significant. The inflationary effects really aren't as significant. The margins are getting squeezed everywhere, but there's certain select areas that I think if you really are selective in the asset class you choose, there's still really great opportunities.
I'll just add, I think if you're talking about BOV versus appraisal, and you're talking about office,
We don't talk about it too loud. And
Yeah.
right. Well, I'm going
For
to.
some of us, yeah.
Just
Yeah.
the door's closed. The difference is if you're getting a BOV, they're telling you what the liquidation value is today, and that's typically not going to mirror what the appraised value is going to say. The appraised value is going to say we haven't seen enough to change our capital markets assumptions, so we're not moving the discount rate up. We're not going to really play with the residual cap rate until we see enough comps in the market, enough pain in the market, where we're going to change that capital markets assumption. I do think, and I think we're going to feel it in the Odyssey Index this quarter, is where they will pick it up partially is on cost inflation.
Yep.
So when they get the new operating expenses on these assets, and it's happening in real time, on those assets where you don't have a triple net lease, you can't mark to market as quickly, there's going to be more pain there. So those office buildings are probably at the top of the list. But on the flip side, if you have an industrial building and you have in a good market, in a good location, and you have less than 5 years of WALT, so you're not priced to a bond, but you actually can mark to market, that feels pretty good. And I don't think you're going to have a big discrepancy there. So to your point, you really have to look across product type and profiles.
So, again, I think with asset classes, again, it isn't one size fits all. We're seeing sort of processes that are happening with certain asset classes that are, vigorous processes and still getting a fair amount of activity, and others with good assets, but maybe the asset class is perhaps a little out of favor. They're just, putting it on the market and there is no bid. So, what about the impacts to liquidity on something like that? What are you sort of seeing in your respective markets, and how do you predict that this might evolve over the next 12 months, particularly if we see a few more interest rate hikes along the way? Do you think people are just going to sort of tap out? We've got a very disciplined market. There will be some forced sellers, the highly leveraged groups, maybe, who might get sort of repriced in all this. But I think, with a lot of the institutional investors, they can afford to take more of a patient tone, as what you were saying earlier, Doug. So keen to hear anybody's thoughts on that. It's a jump ball question.
I am not the institutional guy.
Okay.
So I can tell you that it just creates more creativity.
Yeah.
You just have to think a little bit differently about how you're buying and selling and to whom you're buying and selling, and things like 1031 traders or those type of things. They're always out there. There's those type of guys. We think that it's what I said earlier. In any market, there's always a buyer, there's always a seller. It depends on the price, right, and the motivation. And this market actually, I'll say it again, it doesn't scare us because we think that you need some volatility. When it's just waiting to trade cap rate, right? That's a different game than creating value. Mm-hmm. And we think this is a great value creating time.
I think a lot of people have been skated on side with, the value add.
Right.
Now it's really going to separate, I think, the people who, have that expertise from those who don't. So.
Well, I think, the last time we were in this was the beginning of the pandemic, and there was a dearth of transactions, and it created a bid-ask spread. And because people believed that was relatively acute, we'd never really bridged that bid-ask spread, and we just waited it out, which is why we had, a reduction in transactions over that period. I do think the good news is, the bad news is there's a bid-ask spread right now. The good news is I think that's going to get figured out pretty quick because of the debt, because of the cost inflation. Most sellers are realizing that that's probably here for longer term. And if a seller's or buyer's telling me that this is their new cost of capital, I'm a buyer too. I kind of believe it, and it's not acute. It's probably here for a longer period of time. So I think we'll have a slowdown in transactions. We'll have the bid-ask spread develop. It's happening in real time, as I said. But I think we'll work through it a lot quicker because there's still tailwinds. There's still reasons to invest in real estate.
Tal, I was going to say, Tal, you had something to say about repricing earlier, so, anything you'd like to add to this?
Yeah, so in terms of liquidity, there are two parts to it. There's this one part of what's your structure for your capital, right? There's been a lot of capital being raised, and it depends on the pressure and weight of that capital not being invested. Depending on the structure, if you have a closed-ended fund or even insurance companies that are getting money that needs to be invested. But then you have, on the other side, big open-ended funds like us that have the luxury to open up the floodgates, get more capital, close it up, invest it. And so we can be disciplined in that sense and just say, you know what, we're not going to open it now as much. Let us first see what happens. And including us, I can't share the numbers, but we're still planning to grow at a slower pace, though, and wait it out to not be caught in that repricing. And maybe we'll lose opportunities. We did lose opportunities back then in the repricing you mentioned. I think there were a lot of opportunities just right when the pandemic started, and big and smart and courageous private equity groups and others were stepping into it with a conviction, and they got the rental growth afterwards to benefit from that. And then the second part we talked about before is the asset class. And it's not just the asset class, but also the structure. You, Joe, mentioned industrial, and it's very true. If you have the shorter term and you can benefit from the leasing increases, rental increases, that looks very good because you can access that inflationary side of the rental growth equation. But the deals that used to be the best core deals with a 20-year Amazon and 1.5% fixed increases that are so sensitive to the financial interest rate, they're actually also breaking apart, and they're becoming now almost within that asset class, the less desired, because you cannot access that rental growth for 20 years. So yeah, there's indirect value appreciation, but that's something. So even within an asset class, you have to really be careful what kind of product you're focusing on.
Well, not to mention they've pulled away from a few leases recently, in the U.S., and I think we're starting to see it spill over into other regions. Doug, you look like you wanted to say something.
Yeah, I think it's really important to focus on capital flows and liquidity. And my sense is there's still a ton of equity capital out there that is willing to deploy. They're just trying to figure out the right risk return. But it's there, and there will be pressure over time to deploy it. It's interesting to me. We came through the pandemic, and obviously the hardest hit sectors included lodging and retail. And now I'm hearing there's actually capital that is willing to deploy in those sectors because they're looking at the yields relative to what's available in some of the more favored asset classes. And so it's not a lot of money now, but even just sitting with one of my money center banks, I was shocked to hear that they would consider retail again. I thought that was a no-no, but office is a tough one. That's probably the toughest sector right now, in some ways more so than retail and lodging.
Yeah, and Doug, I think you hit on something really important, which is hospitality, which is retail, specifically experiential retail. We've been through this a little bit before, and that was 100 years ago during the Spanish flu, and then we had the Roaring '20s, which was a pretty vibrant time, and it's really the consumer, and the consumer really stepped up then, and they're really going to step up again. There's a lot of pent-up demand. People want to get out. Look at us. Here we are. We couldn't wait to get into a room and infect ourselves. So it's so it's going to happen again in the next 5
So you don't think
7
we're
years.
going into recession?
I think that there's competing forces, and I think that there is going to be a lot of people on the streets spending money, and they're going to do it in a way that's really going to benefit hospitality and retail, especially experiential retail or bars and that type of thing. Yes.
So Scott, I'm going to ask you to hold that thought, because we're going to come back to it. I just really want to touch on ESG sort of before we sort of move on. Obviously, it's we heard about it this morning. We heard about it last night. It's pivotal, I think, the way most investors are looking to sort of deploy capital. We all have our targets, as I'm sure you all do. I'm going to ask Scott, because I know that you are active in this space, about deploying capital in social or community type investments, and if you can maybe briefly tell us about some of the things that you're doing, and then I'd love to hear if anybody else is active in that space too.
Yeah, I mean, briefly speaking, and it's a long story, but we left Sterling Bay, which is a company I started with a high school friend a long time ago, to start Farpoint about 6 years ago to do more socially impact investing. So, and one of those things, and really the crown jewel of what we're doing is what we call Brownsville Lakefront, which is here in Chicago, which is about it'll be close to 100 acres on the lakefront next to McCormick Place, and really the entire idea of that, and I say I'm kind of thankful to two events, not which are good ones, but there's a guy serving 30 years in prison in Brazil right now for bribing the Olympic Committee, so that Chicago didn't get the Olympics in 2016, because this was supposed to have been the Olympic Village. So thank you to him, and then really, he didn't answer my postcard. I don't know why. And really, the entire Black Lives Matter movement made our site much more relevant, because there's a real willingness and in many cases a mandate by corporate America now to invest in areas such as the near south side of Chicago. So there are things called the social determinants of health. I was born in Evanston, and my life expectancy is 30 years more than had I been born in Englewood on the south side here in the poorest parts of Chicago, and that's not okay. And the reasons for that are not gun violence, but it's really security, food security, housing security, job security, educational security, just walking out of your door and just knowing that you're going to be secure. All those things contribute to that, and that's all the things that we are addressing on our site here, which will be sustainable. We've partnered with a guy named Jason McLennan, who is the author of something called the Living Building Challenge. This is a very long answer. I'll wrap it up. But he and Jeff Bezos are building Climate Pledge Arena in Seattle right now, which is the first carbon neutral sports arena in the world. Our whole site will be that. We are bringing in global startups to address the health inequities in our community. We are a diverse team that we put together by design, and it's not just how we look, but what we do. So all those things are, we think, hit on really all those ESG issues embodied in one development, and we're pretty proud of that.
Yeah, obviously we've all been talking about the E. I think, the S has really sort of become, amplified. So thank you for sharing some thoughts on that. To the rest of our panelists, are you guys doing anything sort of on the social or impactful side, or, anything particularly? I presume you've all got your, net zero targets and, what you're trying to sort of do on the E side, but anything that you'd like to sort of share today that you're working on?
Yeah, we're a small firm, so we don't have a dedicated team to this area. But when you think about the ESG principles, it's just good business.
Mm-hmm.
It's the things that we're thinking about and looking at, and it's built into every investment memorandum in terms of risk profile and opportunity. These are things that tenants want. And so your assets are going to be more attractive to your client base. It's good for your people, to have a more diversified, social network. Decision making, it's been proven decision making is better, with greater diversity. But we as a small firm, had to go out and hire a consultant to help us with this. We needed to create a mission statement. By the way, our firm mission statement needs to be reflective of our commitment here. Otherwise, you can't tell people in a private placement memorandum you're doing it unless they see it in your firm mission statement. So that's one thing we've learned recently, and we're looking at it across the board. But it's not easy. Every time we knock on a door and talk to institutional capital, it's a topic for conversation. Every single consultant that reviews us on a quarterly basis asks us to fill out, where we stand in a broad range of measures. So it's very real, And it affects even, smaller firms like ourselves that are active in the middle market.
So just maybe staying on ESG for a minute, question for Joe, slightly different question. I mean, how's climate change sort of evolving, your investment strategy, what you're thinking about? I mean, Barings is, has a fairly large footprint, and then obviously I'd love to hear from Tal too. How are you sort of changing what you look at and what you want to do, and maybe dealing with what you've got and managing your sort of portfolio construction, with this sort of theme?
Well, I mean, we're owned by 100% owned by MassMutual, so we have a multi-billion-dollar separate account with them. MassMutual is net carbon by 2040 or carbon neutral, and so we are focused on ESG. It's got to be through the vernacular of our entire organization, because there's a lot of greenwashing going out there. The SEC knows it. They're focused on it. They're digging into it. And we haven't been perfect, and we're getting better, but it starts at the top. And on climate risk, we're getting asked the question by MassMutual in their portfolio. We own we developed a big portion of Fan Pier in the Seaport District in Boston, which is obviously, with sea level rise, definitely a focus of ours and MassMutual. So they're challenging us, we're challenging ourselves. We're digging into MSCI and Moody's climate impact forecast models of sea level rise. We're focused on extreme heat scenarios, catastrophic storms, fire. But I got to tell you, each deal that comes across my desk or the acquisition person, it's a little bit more reactive to, okay, in our investment memos, we have to rate all of these categories. And we can't just rate it subjectively, right? So the question for a lot of investors, I don't think anyone's really figured it out really well, is, what is the index? What is the weighted risk? And how are you quantifying and qualifying that to your investors and to yourselves? Are there deals that are going to hit, certain levels where you say it's not even a pricing risk? It's not gapping out my cap rate. It's, I ain't going there. And I think it's a challenge for all of us. And if any investor says, oh yeah, we've got the perfect model and we figured it out, we just don't do this. Unless they've just created an edict. I'd like to know how they've done it. We're just focused on it. There's a lot of technology. A lot of firms are focused on it, consultants, so we're digging in with them. I don't have a perfect answer.
It's a hard question.
It's hard, like, do I want to go out and buy a hotel in the Caribbean? I've kind of said no to any of those deals that come across.
Right.
And how close to the coast do you want to be? So,
Exactly.
it's a focal point, but I can't tell you it's black and white.
And Tal, how's Union looking at it?
Yeah, I think let's start with the climate risk, because you just talked about it, and
Don't
then
make
go
me
back
look
to the
bad.
environment. I think we're not as strategic about it as you were describing with analysis, and obviously we all seen and heard about the UN report and what that means. But I think where it makes its way into your underwriting is when you start asking for insurance quotes. And if you're in a flood zone and you ask for insurance quote, you may have to either adjust your pricing or just get out of the deal. And so I think the reality is that all those things we have in an underwriting, you talked about inflation, on the operating expenses, all those things are actually in there, which is good. It should be in there. And so I think, especially in multifamily, where you cannot pass that cost on to your tenant, that's a very, very big hit on your net returns. And so I think that slowly will become more relevant. I actually just heard about an investor that pulled out of a deal because of the flood insurance being so expensive. On the other side, talking about the environmental part, the Europeans are much more advanced than the US. And mostly that's driven by laws, and the laws obviously are also driven by politics, but they call it taxonomy, even though it has nothing to do with tax. It's just a term, I don't know who came up with it. But we have to now, because we call ourselves sustainable funds, there's a minimum threshold of sustainable investment. So when we go into an acquisition process, and the focus used to be LEED certificate. But you could get a lot of points by putting up a couple of plants on the roof or bike rooms and stuff like that. So you could have a LEED certificate but not really be a sustainable, environmentally friendly building. And so now it's switched from that European perspective to Energy Star rating. And just to give you an anecdote, how not advanced the US market is in that, I was just looking a year ago, 7 months ago, where still ESG was a big topic throughout every conference, right? But I was looking at a deal in Austin, and the offering memorandum for an office deal had the LEED certificate on top of it and within the OM, but they didn't have an Energy Star rating. And so you wonder, is there no rating, or did they just not put it on? And there was a rating, they just didn't put it into investment memo. And it shows how the community just has to catch up. And obviously more and more of this making its way through the US, and it's definitely coming. So for us, it's a critical item. We cannot buy something that we cannot at least get to sustainable. That would be an exclusion criteria in the investment process.
Well, I'll tell you, there's a European investor I mentioned earlier in the panel, and it shows you how focused Europe is or ahead of the US. And Article 8 reporting, you're familiar with it? Probably some people are, I wasn't familiar with it. They said, if we come into your fund, we want you to be Article 8 compliant. And so a couple people who were pitching said, well, okay, great, we'll do it. and then you have to backtrack in a pitch with a big investor and say, well, I'm responsible for the fund. I don't know if we're going to be able to do that. So, you know, that shows you where quickly greenwashing can happen without even knowing it. And Europe is way ahead of us.
Yeah.
Those are great comments. So maybe let's just sort of switch gears a little again and maybe talk as an adopted Canadian, sort of the phrase where the puck might be heading. And so the next sort of few points that we're going to cover sort of is sort of looking forward. So obviously, I think we'd be probably remiss if we didn't sort of touch on, you know, workplace and how people are going to work and collaborate sort of post-pandemic. I'm keen to sort of hear, you know, each of you sort of like what your house view is on that, and also what you're doing within your own respective organizations, how you're viewing the workplace, how you're viewing collaboration. I mean, obviously we're all here and in person. So, you know, in no particular order, I think I'll start with Scott.
Yeah, I can tell you anecdotally, about a week and a half ago, we had a meeting. There were 14 people in our office, and there were probably another 7 or 8 on Zoom, you know, and we had a really great and very technical meeting that lasted about an hour and a half. And then when the meeting was over, the Zoom turned off, and the people in the room sat around for another 45 minutes, and a lot of information was really exchanged, and a lot of personalities were, you know, got to know each other, and there was a lot of interaction and collaboration. And I think that, you know, the minute those people on the Zoom realize what happened in the room, they're going to be back in the office, and, you know, or in in-person meetings. Or, you know, I heard Sam Zell say the minute somebody gets a sale because he hopped on a plane as opposed to trying to sell somebody by Zoom, everybody's going to be hopping on a plane. So, and then there's all the cultural and all those issues that you just, we're all social, you know, people need to be together. Yes, there are certain jobs, there are certain times, there are certain reasons that you can be remote, but the office environment is really important.
Joe, any thoughts on this?
You know, there have been so many panels today that have talked about this, so I don't want to regurgitate too much, but you know, we've got a fund that primarily invests in what we call STEM office and life science. STEM office is just, you know,
Can't do science at home.
It's creative office.
Exactly.
And we're not going to invest in any office if we can't figure out what's critically important about that office's ability to drive employees into the office. You know, I want to invest in a building where HR says this is a tool to recruit and retain talent. And there are a couple pieces that are interesting that we're seeing real time. It's not just about the ceiling height and the light and air and the elevator capacity and the authenticity of the asset. It's also about the location. You know, can you create the amenities within the asset, or is it walkable? I was in San Francisco last week, and there were literally quadrants of downtown where we stood at the top of the building, and the leasing broker pointed to me and said, yeah, that section of town right there only has 15% of the workers coming back to the buildings. That area over there has 42% coming back. And because it's walkable, it's where people want to be in the urban environment. And then, so if you switch from urban to suburban, you better have something like a campus. It's got to be cool, it's got to be tech-oriented or innovation-oriented. Anything outside of that, this is really interesting. Suburban office, there are now trades happening in suburban office as a covered land
Yeah,
play for industrial.
logistics.
So people are buying
Yeah.
suburban office right now
Yeah.
for covered land carry to build, knock it down and build industrial, because
The
land
Allstate
values for
I've seen a few
industrial,
deals come across my desk.
land values for
Exactly
industrial are
that.
$600 to $700 a
Yeah.
foot in some of these areas, and the office building isn't worth $100 a foot.
Yeah, and the industrial rent can be $20 a foot, and the suburban office rent $18 to $20.
So when people
So
say the
it's-
have and have-nots,
Yeah.
that's the have-not, right? And so we're not going to invest in anything like that. We're not going to be, you know, graveyard diggers like I used to work for Sam Zell for 12 years, so I can't say I subscribe to that strategy right now.
What about you, Doug?
Well, we don't think office is going away. Just in terms of our firm, we've been going into the office every day. We have a small firm.
Are you getting any pushback on that?
You know, we get a little pushback from older attorneys and accountants.
So not
And-
young ones like Peter Roth.
No, no, the young ones, and this is the point too. And we, you know, when we were hiring people coming into the firm, we actually talk about the excitement to be in the work environment. And if they aren't interested in that, they're probably not right for our corporate culture. So we're having that conversation early. The thing that I worry about most is really the young people and mentorship, and having our young talent surrounded by more experienced transaction professionals, interacting, you know, if you're on the transaction side, interacting with the asset management side. I mean, there's just so much to our business that you need to be in person to think about strategy and portfolio. And I agree with Joe. I mean, haves and have-nots. And so short term, you know, there's a lot of uncertainty there. You know, in the large cap markets, the mass transit markets, you know, I think there's going to be a lot of pain. These large floor plates, large tenants, really, you know, still debating what the return to work is going to be, and significant sublet space out there in major markets, with more on the way. But yet, in a city like Chicago here, where that is the case, you've got your have and have-nots. You've got LaSalle Street, which has been decimated, you know, with tenants moving west and thinking about downsizing or moving into newer, more efficient buildings. And then you've got Fulton Market, which is just on fire. It's the largest, I think it's the highest growth submarket for office in the country. Now, we're not talking about big square footage here, but it's the 24/7 live work. It's where the young people want to be, and they're filling that space. So I agree with Joe on the have and have-nots. And then it's also, you know, it's market related too. I mean, you know, I think Fulton Market is an exception, but we've seen a lot of migration out of Chicago and other major cities where tax and regulation are big issues, and companies, if they're going to move anywhere and they're going to locate and try and attract young people, they want to be in places like Nashville, Tennessee.
Tal, anything to add, or
Yeah, sure. I mean, we're a big office investor. I mean, globally, we have a big part of our portfolio in office. In the US, we have almost 75% in office. So in general, do believe that the office will be needed. We cannot deny what's going on. And because we have so much, I was reading up a lot of that topic and wrote a couple of articles. And my arguments just 6 to 10 months ago were still, well, if you have what a lot of companies are doing, the hybrid work, and most of them started with 3 days in the office and 2 days out of the office. The argument was that Monday and Friday, if that's like the days where people are going to be home or close to home, you'll have a pretty good occupancy from Tuesday to Thursday. And you cannot reduce your office space by the average occupancy, you can only reduce it by the peak occupancy. Now, we cannot deny, and that's the new data that's coming out, there are a lot of people, just anecdotally, but also surveys showing that a lot of people are switching to 2 days. And are starting to say, you know what, I love collaboration, it's all great, but do I want to have 2.5 hours commute on that day for that 10-minute conversation after the phone is off? Or do I have these 2.5 hours to myself, to work out, to talk to my family, to have lunch with them? And so there is a definitely other side to it. And then there's not just a hybrid workplace, there are some companies that are going fully remote. and they could live wherever they want. They don't even have to be close to some place. So there's definitely going to be an impact, and you can find anecdotes for any part of it, but one thing that we cannot deny, and one example of that flight to quality and amenity space and so on and so forth, was HSBC just moved from Bryant Park in a good building to the Spiral from Tishman Spire, and reduced by almost 50%. And that's something that we cannot deny, so we really have to focus on it, look for the science and look for what people actually do. And it's very, very complex because company size, culture, are you a small company that are very cost sensitive and you actually are benefiting from having less office space? There's a big part of it, but the question is only by how much is the demand going to be reduced and by how much is the new construction slowdown, hopefully eventually going to get into an equilibrium that we're back. But looking at the cap rates, right, on some very, very good office buildings, you're getting closer to a 5 cap in some markets, where multifamily we're closer to 3. So there is eventually one point where that is priced in, and a lot of people say, well, we're not going to keep on investing in office. So that money that flew into other asset classes left a little bit of a hole that creates some opportunities where pricing eventually will make sense.
I mean, one of the things we're seeing on the leasing side, I mean, my role is sort of definitely very leasing focused, and we're sort of seeing in the newer construction and the best buildings, and it doesn't really matter what the market is the economics are usually getting solved on the first or second round. It isn't about the economics. The tenants will pay the rent, right? And what's interesting is it's the other stuff, and it's the desire to be in those experiential, highly amenitized buildings. And, you know, I mean, at the end of the day, I mean, these are HR-driven decisions. I mean, I was sort of, again, having a conversation last night. I mean, you know, do we think that, you know, there's going to be people who almost self-select themselves out of the rat race and say, you know what, I'm happy sort of taking, you know, a sort of a second stream to my career. Maybe I'm not going to be, you know, getting the biggest bonus and the biggest pay rise, but I can do this job, I can work from home, I can have more balance. And then there are other people who say, hey, I still want to kill it, I want to be in, I want to be present, I want to be known, I want to learn. And so, you know, it's going to be very interesting to sort of see, sort of watch this play out.
Can I just add
yeah,
to that?
of course.
This is something that I've seen over my entire 30-year career, but it's exponential right now. If you create great product, people will pay for it.
Yeah.
Over the past 10, 15, 20 years, there's been a concept that there's a market level, and then people stay within the market level, but they move a little bit up for great product.
Yeah.
What I'm telling people now is I think it's asset level. I think you can look at asset level rents in a category. You have to pay attention to the market, but if you have those companies in the market, you have that workforce in the market, and you can truly create something special, that's an asset level rent, that's not a market level rent.
100%.
And we've seen it. I did a development years ago with Ed Minskoff, 51 Astor Place, and I couldn't find a rent that was over $55 in the area. It's by Cooper Union Engineering School in New York. There was no tech product. We built a brand new building, and Ed said, I'm going to lease it for $85 a foot. I said, Ed, there's no comp. It's not even in the realm of possibility. We ended up leasing it, our first lease to IBM Watson for $110 a foot. Because Ed got so greedy, which I love, and said, you know what, for IBM Watson, that's $110 a foot, and it doesn't matter. The rent just doesn't matter for them. And so, you know, you have to be careful because you have to really know that that's differentiated and it's in a supply category of its own. We did Empire Stores building in Dumbo. You just name your rent. So if you can find those opportunities, this is not market level rent anymore because of everything that's happening. It's been accelerated. It's a whole new category. It's exciting. To be a value add office investor, for as down as we sound, it's really exciting if you can do this.
Yeah, I mean, it's a market unto itself. I mean, Carly mentioned this morning about the deal in One Vanderbilt at $300 a foot. That's a real deal.
I don't
it's a
believe that
family office. That's a Canadian guy, GFL Environmental. He's a garbage collector, and he's made billions. And it's a family office, and it's $300 for 5, $320 for 5. And, you know, again, economics, you know, not even a factor. So I guess, you know, to allow some time for questions, maybe just one or two things I just want to touch on. I mean, where do each of you sort of think the opportunities lie? I mean, as you sort of look forward to the next 12 or 24 months, you know, what's going to be your priorities in terms of, you know, the investments you look, the things that maybe you'd like to sort of steer clear of? You know, maybe I'll start with Doug this time.
Yeah. I think the opportunity set for us right now is much more interesting on the credit side of our business. Our phone is literally ringing off the hook because we provide gap financing, either in a mezzanine or a B note or a pref equity structure. And with the rise in rates and pullback in senior loan advances, there's a real demand to fill that gap. Sometimes it gets filled by the equity. Sometimes the equity is looking for a way to top off of financing, and we can provide acquisition financing. That's a tougher task right now because when you layer in our mezz with the senior that's gone up, it's getting really thin on debt yield. So that trade is a challenge, but on strong value add acquisition opportunities with good sponsors where there's a business plan that makes sense, that's where our mezz can come into play very nicely. Construction mezz selectively for best-in-class developers on projects that make sense. We'll finance up to probably 80% of cost, and we'll underwrite based on sort of our new look and revised exit cap rates. And keep in mind, we're in a debt position. The equity's coming in a first loss, so we're covered. We're getting paid very well for that position in the stack. We're sort of high single-digit, low double-digit returns for what is generally 60% to 80% in the stack. And I think that's a very attractive risk return, in many ways better than what we're seeing on the equity side of our book. And so that's where we're probably going to be most active.
Scott, how about you?
Yeah, for us, it's a couple of things. One is this project I talked about on the south side, where we're literally creating a community there. So that's all value add. And but other than that, we're looking at specialized assets. We're doing these data centers. We're doing controlled environment agriculture, which is really indoor farming. We think is great. And then geographically, besides Chicago, we like the Alabama, Carolinas, Georgia market for multifamily and industrial.
Joe?
Anything attached to innovation, whether it's really a demographic strategy, so we want to go where, as you said, the puck is going, although the Bruins just lost Game 7, so I'm upset about that.
The Leafs lost too.
You got the Celtics stuff.
Celtics?
The Blackhawks didn't play this year.
But innovation, we're doing a lot of research into, we've gone historically back and said, what is innovation in real estate? And it's really a combination, we think, of a STEM employment base and a highly educated workforce. You put that together in a blender, you create innovation. So we've actually gone back, and if you look back 30 years, when you get to a market level where about 40% of the population has a secondary degree, and then you marry that, we tested it, we found the intersection where, and then there's about 9% of the population is STEM related, so science, tech, engineering, and math. If you can figure out where that's evolving and about to hit that level, you can really invest accretively. And so we're focused, whether it's office, resi, retail, or industrial, is following that skilled worker migration, that higher wage earner migration. A lot of those markets are known, right? But the key is, and we continuously test it, if they're getting to 38% and 8%, we want to keep following that puck because there's a lot of interesting markets because the U.S. is a lot flatter with technology and quality of living and cost of living. It's really all about that. Secondly, when it comes to office, we strongly believe in it, but it's life science and it's tech. And what's really interesting, we did a big deal with Meta. We thought we were going to buy 2 buildings and then build a 3rd building on a pad. We designed it for life science. Facebook came along and said, you know what? We'll take the whole project. It's in Burlingame, South.
Did you sign the lease?
We signed the lease.
They just tapped out of most the deals.
They put us
locally.
on hold for 60 days.
Yeah.
So I had 3 heart attacks and 1 stroke. And the Wednesday before Thanksgiving, they signed it. But Facebook came to us, and we had a full life science plan because it's Burlingame, south of the airport. This is where life science needs to go because north of the airport, it's tapped out. And they come along, and we designed the life science building with our development partner. And Facebook came along and said, well, you had 16-foot slab to slab. Can you make that 18? And you have 100 pounds per live load, but can you make on the flooring, can you make that 150? Can you make the glass 45 pounds? And we're saying, guys, it's a frickin' tech building. They said, no, it's not. So there's convergence happening right now.
Yeah.
We're seeing it where tech, it's not just life science, it's artificial science. Facebook is going to use that building as a laboratory, right? And so you're starting to see technology tenants require robotics, artificial science. We toured the competitive set. There was a single-story building that I saw in San Francisco, and it didn't have a name on it, and it was a laboratory. And I asked the leasing guy as he was driving me around, "Do you know who's in that 100,000 square feet?" They said, "Yeah, that's Impossible Brands. It's food."
Yeah.
Right? So you're starting to see this convergence where real estate is becoming critically important for science, and that bleeds into office. If people haven't read, there's a book called The Future is Faster Than You Think. Go out, buy it, and read it. It's going to tell you a lot about the future.
And Tal.
So either Joe copied our strategy or we are copying his because it's pretty similar. The
So you're
data
going to
is,
sell you all my core deals every time.
we should.
So you don't
Or we should
discriminate
just
on asset
JV.
class, you follow the demographics.
Well, you follow the demographic, and really with that, you're following the rental growth, right?
Yeah.
And there's so many parts to the rental growth. If you have oversupply, you won't have rental growth. If you have migration with a reasonable, balanced pipeline, you will get that rental growth. And obviously, a lot of those fast-track movements that happened in the pandemic. So we've been pretty early movers for Foreign Group, especially into the, we call secondary markets. Like in Austin, we started to go into 2013. And so in terms of geographic, we believe in that. And then within a market, you mentioned, for example, Fulton market, we don't just look at an average rental growth of a full MSA, because then you have to figure out, so if you choose the right growth markets within that market, the right sub-market, and some of the best deals that we've done were core long-term leases in office, for example, in an evolving market like a Seaport in Boston. So you have the best of both worlds, because you get the downside protection with a long-term lease, and you get everybody around you developing for you, and the rents are pushed up by creating density. So that's part of what we were trying to
Just make sure you do
achieve.
your climate risk study on that one.
Oh yeah,
So
exactly.
we got about
exactly.
2 minutes left, and I just before we any questions from the audience? Bueller, anyone?
Good.
No.
Said it all.
Okay. Well, I just want to thank our amazing panel. Hopefully that discussion was I enjoyed it, and hopefully you all
Thanks
did
to our
too. So-
moderator as well.
Yeah.
Thanks.